Conflicts of interest has three standards: disclosure of conflicts, priority of transactions, and referral fees. 6A is disclosure of conflicts. The larger point here is that ideally in the investment management business, the best practice is to avoid any conflicts. However, that is often difficult to do, and the code and standards recognizes the fact that there will be several conflicts. If not actual conflicts, then there might be a perception of a conflict of interest. And this particular standard explains how to deal with those conflicts and specifically how to disclose those conflicts. Members and candidates must make full and fair disclosure of all matters that could reasonably be expected to impair their independence and objectivity or interfere with respective duties to their clients, prospective clients, and employer. Members and candidates must ensure that such disclosures are prominent, are delivered in plain language, and communicate the relevant information effectively. Let's look at the guidance, and the point is that conflicts can appear in several forms and in different aspects of your work as an investment manager. So let's look at the disclosure of conflicts to employers. We've talked about the fact that if you work at a particular company, and let's say this is an investment management company and this is you, are there potential conflicts over here? Obviously, the answer is yes. We talked earlier about a situation where a client wants to compensate you for the excellent work that you've done. Does that create a potential conflict of interest because you might then be biased towards this client at the expense of other clients in the company? The answer is yes. And clearly, this conflict needs to be documented. Another scenario might be that you are working at a charitable organization. So on the surface, your work for this charitable organization does not have any conflict with your work at the investment management company. However, you are passionate about this cause and spend a lot of time working over here, spend a lot of time thinking about this work, and that potentially creates a conflict because it takes away some of your energy that you should be giving to your client to this particular engagement. If you feel this is possibly the case, again, this conflict needs to be disclosed. Another simple scenario that we'll talk about here and then talk about again later is where you own certain stocks and you are also trading these stocks for your employer. That creates potential conflicts of interest that need to be disclosed. Moving to the next one, disclosure to clients. Some of the items here will be similar. If you are trading for your client and you own the same shares that you are asking your client to buy, clearly there is a potential conflict of interest. You might be asking the client to buy those shares so that the share price goes up and you personally benefit. Another situation might be that you receive compensation from your employer for recommending certain mutual funds to the client. Now, this conflict needs to be disclosed because when you are recommending the mutual fund to the client, obviously the client believes that you are making this recommendation with the client's best interest in mind. But if you get a 1% commission for making this recommendation, that commission needs to be disclosed. The client can then evaluate for himself whether the recommendation that is being made has anything to do with the 1% commission that you get. Another possible situation is where you are making buy recommendations to your clients for a given stock. Let's say you are making a buy recommendation for General Electric, and at the same time you or your organization has an investment banking relationship with that same company. This needs to be disclosed to your client because your client can then decide for himself whether this buy recommendation is in his best interest, or is it possibly being made because you, the investment advisor, would like to keep GE happy because of that other potential business that you have with GE. And this connects with the next item, which is cross-departmental conflicts. And we've talked about this in earlier standards also. A classic scenario is that you are a research analyst at a brokerage firm. So there is the research department and then there is the investment banking department. The investment banking department might put pressure on you to write favorable reports for certain companies, specifically those companies with which the investment banking department either has a relationship or wants to build a relationship. Now, what do you disclose? We've talked about the fact earlier that if there are companies with whom your investment banking department has relationships, ideally those should be on a restricted list. But if that is not the case, let's say you work in a relatively small country where it would not be practical to do this, then the fact that your company has a relationship with these companies needs to be clearly disclosed when you are making investment recommendations. A big item that I've already alluded to before is conflicts with stock ownership, and this applies both in terms of disclosures to employers and disclosures to clients. If you own a particular stock and you are trading that same stock on behalf of your employer and you are encouraging your clients to buy that stock, clearly there is a conflict of interest that needs to be disclosed. Conflicts as a director. This is where you are working in the investment management industry, and let's say you are also the director of a given firm. In other words, you are on the board. As a director, there are three possible conflicts that might show up. We can refer to these as conflicts, or these are areas that might make it seem like there is a conflict. Number one, there will be a conflict or a potential conflict between the duties owed to your clients and the duties owed to the shareholders of your company. In other words, as a director, you need to represent the shareholders. As an investment manager, you need to do what is best for your clients, and at times there might be a conflict. The second scenario is where you receive securities or options to purchase securities of the company as compensation. So you are on the board and you either get company shares or you get options, and this might raise questions because clearly you get rich if the stock price of the company goes up, and you are advising your clients. Let's say you advise your clients to buy the shares of the company where you are a director. That would be a conflict, and this also connects with the earlier item that we just talked about. The third scenario is where your service on the board or your position as a director potentially makes you privy to material non-public information. So if you are trading, there might be questions as to whether you are trading based on material non-public information. In terms of recommended procedures for compliance, you should disclose special compensation arrangements with the employer that might conflict with client interests, such as bonuses based on short-term performance criteria, commissions, investment fees, performance fees, and referral fees. In simple terms, any sort of compensation that you get where there is a potential for the appearance of a conflict of interest, that should be disclosed. If your firm does not permit such disclosure, you should document the request and may consider disassociating from the activity. I'll give you a simple example. Let's say that when you sell mutual funds to your clients, you get a 1% commission. And let's say that your firm does not allow you to disclose this commission. That would be a major problem, and in this case you may consider, in fact you should consider, either asking your firm to fix this problem. If that doesn't happen, then you should disassociate from this activity. 6B, priority of transactions. Investment transactions for clients and employers must have priority over investment transactions in which a member or candidate is the beneficial owner. Make sure you understand this beneficial owner concept. When you execute a transaction where the transaction is happening for your own account, obviously you are the beneficial owner. But let's say that the transaction happens through your spouse's account or your children's account or your parents' account, even though those accounts are not directly in your name, but you still benefit. So in a sense, you would be considered the beneficial owner there. The point is that this particular standard applies not just to your account, but to the account of anyone with whom you have a direct relationship. Coming now to the guidance, the first point has to do with avoiding potential conflicts of interest. As I mentioned earlier, the best practice is to avoid anything that creates a potential conflict of interest, but in the investment world that might not always be possible. Conflicts of interest will exist, and in fact there is nothing inherently wrong with someone in the investment profession making money on his trades. So if somebody buys into a stock when it is priced relatively low and sells later when the price is high and makes money, there is nothing inherently wrong as long as he follows three basic rules. Number one is that the client should not be disadvantaged by the trade. In other words, let's say you are the investment management professional, you execute a sell order. That trade should not hurt any of your clients in any way. Rule number two is that you should not benefit personally from trades undertaken for clients. Because if that does happen, if you are benefiting personally from trades that you execute for clients, then that creates the appearance of a conflict of interest. And the third rule is that you must comply with all the relevant rules and laws. As long as those three things happen, as long as those three rules hold, you can execute transactions and make money. Another point over here is that there will be situations where an investment manager is executing transactions for himself or herself that conflict with his recommendations. For example, let's say that you have recommended that a particular stock is a buy, but your personal situation is such that you need to pay for your children's college education and you happen to have a lot of those shares where you are recommending a buy, but because of your personal situation, you need to sell. This is appropriate. There is nothing wrong here as long as you follow the three rules that I just talked about. The next point is that personal trading should be secondary to trading for clients. This point has been made several times before. If you are executing trades, first you should execute client trades, then you should execute your employer's trades, and then any personal trades. The reason is fairly straightforward. Let's say that you are buying shares. When you buy shares for a large client, and let's say that this is a significant transaction, buying shares means that the stock price will go up. So you need to make this happen first. In other words, you are getting your client to buy at a relatively low price, and only after the stock price goes up do you buy for yourself. If you did things the other way around, where you bought for yourself first and then for the employer and then for the client, there would be an obvious conflict of interest because then when you buy for the client, the stock price goes up and you have already purchased at a lower price. So that's why this point is extremely important. Standards for non-public information. Simplistically, this says that if you happen to have any non-public information, this should not be communicated to anyone whose trades will benefit you in some way. And obviously, if this is material non-public information, then you should not be acting on it and you should not cause anyone else to act on this information. Impact on all accounts with beneficial ownership. You may undertake transactions in accounts for which you are a beneficial owner only after your clients and your employer has had an adequate opportunity to act on the recommendation. So I'll make this simple. You are, let's say, working as an investment manager, and very recently your group has made a buy recommendation on a particular investment. The first opportunity to act on this buy recommendation should be with your clients. After that, there should be enough opportunity for your employer to act, and only once that has happened can you yourself act on that information. So this also connects with information that we have discussed earlier. Another point made in the curriculum with regards to this bullet is that, let's say that one of your clients happens to be a close family member, and this close family member is a regular fee-paying account. Then your actions should in no way either benefit this client more so than others or put this client at a disadvantage relative to others. In other words, your close relative needs to be treated like any other client because this relative is paying the same fees as other clients and hence should receive the same level of service. Firms should establish procedures that deal with the potential conflicts of interest that we have been talking about. One major area where we have conflicts of interest has to do with equity IPOs. To understand the context here, IPO refers to an initial public offering. There are times when we have an oversubscribed IPO, or what's sometimes referred to as a hot IPO, where the perceived or expected demand for the IPO shares is very high relative to the supply. There is therefore an expectation that after the IPO, after the initial public offering, the share price will go up. This then becomes obviously an investment that many people desire. If investment professionals get an opportunity to participate in the IPO, then that creates a possible conflict of interest. In fact, there are two aspects that need to be considered over here. Given that the IPO shares are in short supply, if the investment professionals get a piece of the IPO, then it might appear as if the investment professionals are getting an advantage over the clients. In other words, the interest of the investment professional is coming ahead of the interest of the client. So that's one possible issue. The other possible issue is that the party that is giving the investment professional the opportunity to participate in this IPO ahead of the public or ahead of other clients, then possibly this is being done to bias the investment professional in the future. And again, that does not look good. That makes it appear as if there is a conflict of interest. For these reasons, it is generally recommended that investment professionals stay away from equity IPOs. From a company or a firm perspective, it might not always be practical to simply say that investment professionals are not allowed to participate in IPOs. It would then make sense for firms to establish reliable and systematic procedures such that conflicts relating to IPOs are identified and dealt with by the supervisors. Also, if you as a member or a candidate are participating in an IPO, then you should get clearance for this participation before actually buying or taking part in any IPO. The next item has to do with restrictions on private placements. Private placements are situations where you might get a share of a company through a private transaction, not through a public transaction. And the concepts here are very similar to an IPO. If you are participating in a private placement, that might create potential conflicts of interest where there might be a possibility that your future judgment is going to be biased in favor of the entity that is giving you this opportunity. Firms should establish blackout or restricted periods. The idea here is again fairly straightforward. Let's say that an investment management company is in the process of issuing a buy recommendation on a particular stock. Now, until this recommendation is issued and the clients have had an opportunity to act on this recommendation, people within the firm, those who are involved in this decision-making process and are aware of the work that's happening here, those people should not be allowed to engage in any personal transactions related to the shares that are being evaluated. If anyone buys shares for their personal account before the client has an opportunity to do so, then this practice is called front running. And as you can probably gather based on our discussion, front running would be unethical and a violation of several standards. Supervisors and firms should establish several reporting requirements, such as what we see over here: disclosure of holdings in which the employee has a beneficial interest. This way, the supervisor or the employer can determine whether an employee is engaging in personal transactions in situations where he should not be. There should be reporting requirements around providing duplicate confirmations of transactions. Again, if there is a front-running problem, then this information can help identify the problem. Also, when employees know that they need to provide duplicate confirmation of transactions, that will serve as a deterrent from engaging in transactions that are not permitted by the company. And finally, something we've talked about earlier, pre-clearance procedures, whereby for an employee to engage in personal transactions related to securities with which his firm deals in, those transactions need pre-clearance. So the employee should get permission from his supervisor before engaging in personal transactions. And finally, disclosure of policies. This implies that firms should disclose their policies related to priority of transactions to clients, and the disclosure of policies should be clear and in language that the client can understand. Vague and general statements such as "we disclose our policies" or "we have policies related to the purchase of securities for personal use" do not really help. The policies need to be clear and in language that the clients can understand and relate to. 6C, referral fees. Members and candidates must disclose to their employer, clients, and prospective clients as appropriate any compensation, consideration, or benefit received from or paid to others for the recommendation of products or services. Before we get into the guidance, let's make sure we understand the concept here. And this point has been discussed earlier in other standards, but it is important enough that a full standard is dedicated to the concept of referral fees. Let's say you are in a situation where you advise your clients on equity investments, and your client now also wants to make fixed income investments. So you refer your client to someone in the industry who provides investment advice and services related to fixed income. For making this referral, you get a fee. What this standard is saying is that you need to disclose to your client that you are recommending a particular fixed income analyst, and for that recommendation, you are getting a fee. Another example that I've talked about earlier is where you might be recommending to your client that he or she purchase certain mutual funds, and you might get a fee for that. You might get a 1% commission, and that commission needs to be disclosed to the client. This way the client can understand the full cost of this transaction. Another situation is where clients have been referred to you. And let's say that when clients are referred to you, you need to pay a fee to the company or the person that has made the referral. Before signing up the client, the new client, you need to make clear that you are receiving this referral fee. So that's why if you look at the standard, it refers to both benefit received from or paid to others. And also note that this needs to be disclosed not just to employers, but also to clients and prospective clients. Coming now to the guidance, advise the client or prospective client before entry into formal agreement. So I just talked about the fact that if someone refers a client to you and you need to pay that someone a fee, before signing up the client, you need to disclose this arrangement. Also, the nature of the consideration or benefit. So the exact fee that you are getting and the terms of the fee need to be disclosed. In terms of recommended procedures, you should encourage your employer to develop procedures related to referral fees. So if these procedures are vague or non-existent, then you should work with your employer to develop those procedures. Employers should have investment professionals provide to the clients notification of approved referral fee programs and provide the employer regular, at least quarterly updates on the amount and nature of compensation received. So there are multiple things happening here. One is we are saying that the employer should insist that the people in the company, the various investment professionals, should keep the clients informed about any referral fees. This way, the clients can act based on complete information. Also, this is saying that from the employer perspective or the firm perspective, the employees are being asked to provide updates on any fees or any referral fees or compensation received through referrals. This way, the clients are being kept informed and the employer or supervisor is remaining informed about what the employees or the specific investment professionals are doing. That is it in terms of standard 6. Do all the examples.